Done. Here we go. So we're back with just a little more excitement in the accounting world as we talk about add or dropping a product line or a division. And so this is the third of our four short-term decisions. And this one, I think, perhaps is our most straightforward. I'm joined again by my good friend and colleague, Eric Valentine.
Hey.
And he's got an excitement that I think is building as we get into this problem. So calm down, Eric. Calm down. So anyway, we'll just take you through this and see where we go. I think this one will go pretty quickly. So anything else we need to think about, Eric, just in general when you think add drop? Well, I tell you what. Why don't you frame it for us like you did the last one? What is kind of the business decision when you think add drop?
Yeah, we have several product divisions, so it's several segments, and some of them on the surface may look like they are not performing as well for the company as a whole.
So that's a nice way of saying that they might be just losers.
Right, yeah. I'm a kind guy.
You are a kind guy.
So they look like they're losers, but if we peel back the layers, if we do a bit more analyses, then we see that they may not be losers.
Okay.
We may be, trying to kill a fly with a shotgun, as they say.
Okay, so they actually might have some value once we take a look at it. All right.
Yeah.
So it's not that the accounting numbers lie. It's just that we need to know how to interpret them a little better.
Exactly. Yes.
Okay. So as we go through this, we're using problem 12.2 out of your book. And in this case, we've got a bike company, and they make three kinds of products. So they have three segments or three divisions. Making dirt bikes, mountain bikes, and racing bikes. And so the total is just straight up the sum across. Okay. Now, I personally like the total over here, but it's just personal preference, and I've changed it for our subsequent analysis. But now I'm a bit on the confused side because I understand variable expenses. And one little thing here is they're doing manufacturing and selling on one line. So remember, all the variable expenses are part of calculating that contribution margin. But then, Eric, they've got this whole bunch of fixed expenses down here. And this is one of those places where our discussion of the types of fixed expenses really makes a difference. So, and you might remember from our last video, Eric's phrase is no change, no matter. Sorry. No change, no matter. All right.
Yep.
So tell me a little bit about these fixed costs, and then we can go look at them in a little more detail.
So if you remember, the traceable fixed costs are traceable to whatever segment where we're analyzing. So basically those fixed costs are traceable to that segment. And if that segment goes away, those fixed costs go away.
So the key phrase here is traceable.
It's traceable.
Okay?
Yes.
What's the opposite of traceable? Not traceable. So make sure you identify that as a key term when you're reading the problem. Okay, what else you got?
And depreciation. Remember, I get my class on this all the time. Like, what they start to tell me about the value of the goods and the decreased useful life. And I'm like, no, it's just the expensing of a cost over time. And so because it's an expensing of a cost over time, that cost is gone. So basically, depreciation is kind of a sunk cost. You can think of it as a sunk cost because it's not going to go away if that segment goes away.
Okay, that's sunk. That is sunk, not suck. Okay. All right, what else you got?
The salaries of the product line manager. That's another key that's another keyword that tells you that that's traceable.
Which one's the key? Which one's the key? The keyword?
The product line manager.
Oh, okay. So, and because that's just another way of saying traceable, right?
Right. It's traceable to that particular product line. Correct.
Okay. All right. So we've got this, and we've got this that you're telling me are traceable. This one
Yes.
is sunk.
Mm-hmm.
And what about these allocated common fixed expenses? That's a lot to say
Yes.
in
Yeah.
one mouthful. What do you got there?
That's not those aren't really those are not sunk costs. Those are costs that are basically just kind of allocated throughout the different segments. So if we eliminate or add segments, we just reshuffle the deck. With
Okay.
that pie is
Oh,
not going to change. That 60,000 pie is going to be there regardless of how many segments we have.
so you're just going to shuffle the deck.
Yes.
All right. This is supposedly a deck. All right.
Okay.
And so this thing is not going away. So it violates, it fits into this no change, no matter. All
Yes,
right.
exactly.
So this is a classic example of Eric's view, his shortcut view of what's important. And so make sure you realize that anything that's allocated is typically not going away. So the
Right.
magic word there is allocated.
Correct.
All right, so let's see if we can go through this analysis. And so what we have for me, as I said, I put the totals over here, okay? And
Mhm.
then in our last video, you might have noticed that Eric made a spelling mistake, at which point I said, ha, 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 I would never do such a thing. And then when I went back and looked at this, I'm now making mountain bikes. Eric, you told me we don't teach spelling. We're just numbers people.
Right,
So
right. Trust the numbers.
yeah. So give us a break on this stuff, people. We're doing the best we can. So this is just a recast of the data that we had, and it appears that racing is the proverbial loser.
Yep.
And so what happens is that the Montaigne group, they are generating the greatest profit. So they are probably celebrated within the organization as the finest and the greatest of the great. However, racing, as losing money, uh, they're not as highly thought of. They're probably in meetings all day. Their friends have abandoned them. Their kids don't get to go out and play anymore. Nobody
Right.
likes the folks over in the racing world. But Eric says that there's hope because there may be actual value in what they're doing.
Exactly.
So let's move over and kind of take a look at that and see where we go. So from a cost benefit perspective, and so Eric, I want to follow up on this because this is the idea of come back again, no change, no matter.
Mhm.
So how does that play in to the benefits here, okay, or the costs that go away? All
So
right.
if we get rid of the racing segment, then
Uh-huh.
the only two costs that we can get rid of are the advertising that are
Okay.
traceable to racing.
Remember what we said, that the key word here is traceable,
Mhm.
okay? Depreciation,
Depreciation, that's the expensing of that sunk cost. So it's sunk. So
sunk, so doesn't play here.
right. And
Salaries,
the salaries of the product line, if the product
product
line goes
line.
away, product line goes away.
So that one's good. And then the
The
magic word.
allocated. Yeah, we're just going to reshuffle the deck, and the other two, the surviving segments are going to absorb that total cost. So we're
Okay.
not giving that money either.
So the total cost that went away were 16,000.
Right.
Okay. So when we talk about value, one of the things that we're penalizing racing for is that they have some of these costs in here that they can't control.
Yes.
And so they might want to, perhaps they're doing better than we might think. because they're also trying to cover these extra expenses. So let's look at the cost side. What do they lose if we get rid of this product line? So the cost of this is fairly straightforward. The costs on these things are any revenue lost, or in this case, contribution margin lost, because if we lose that, we're worse off. So in this case, we would lose the contribution margin on that racing division of 27,000. And the result is going to be the cost of this are 27, the benefits are 16, costs are greater. Do not drop.
You remember, it's kind of like one of the videos said, we're actually paying $27,000 to save 16,000. Doesn't make sense.
Oh, okay. Tell me that again.
We're actually going to pay, in effect, we're actually being asked to pay $27,000.
Giving up that 27,000 in contribution margin.
Right. In order to save $16,000 in costs.
Oh, that's a clever way to think about it. Okay, so we're trying to reduce our costs, and a lot of people will look to accountants as that focus. Oh, reduce costs, reduce costs. When in reality, some of our revenues may be lost at the same time, or profit is lost at the same time. So we have to be really careful with that. Now, in this problem, they also highlight an alternative way to approach the problem. I like this one as well. They're both fine. But the next one is what they call the income statement approach. And all you're doing is, as Eric was saying, is you're reshuffling the deck. Some things go away. We still have our three divisions to think about, even though racing was going to go away. The question is, what costs will remain in racing? So it's just kind of the opposite look.
Right.
So what costs will remain in racing once we take out that contribution margin and we drop these things? So what would happen then is we're left with this extra $20,000. You might remember it's part of the part of the depreciation. It's still going to be there for the company to cover. And they're still going to have these common costs that somebody's got to pay for as well. Right. And the only people left to pay for them are dirt and montane. All right. So those are the only two that are left. So Eric, take us again through this idea of reshuffling the deck.
Yeah. This is kind of a mirror image of the analysis we just did. So that depreciation is not going to go away.
Right.
So it's going to be reallocated, or it's going to be reassigned, it's going to be absorbed by the other two segments. And the allocated common cost is exactly the same thing. You're just going to, instead of it being allocated over three segments, it's going to be allocated over two.
So essentially what's going to happen is that potentially, just for a simple example, is that 20,000, let's say we just split it. 10,000 now has to be covered by the dirt bikes, and 10,000 has to be covered by the montane bikes. And so we wind up with 7,000 and 14,000. And now the apparent loser is going to be the dirt. Okay, because right. they are the lowest of the two remaining. Now,
exactly.
This kind of idea that once you start dropping products, other ones start looking worse is a concept called the death spiral.
Yeah, it's true.
And which just means that as costs get reallocated and you continue to shuffle the deck, the costs don't go away, but somebody has to pay for them. And so products can become increasingly unprofitable, okay, as they're being asked to cover some of these costs that don't go away. And so the difference between the new income of 21,000 and the income we used to have of 32, we now look like we're worse off by 11. And that's the same thing that we came up with over here, the difference of 11. Okay?
Yeah.
Anything else you want to add to that one, Eric?
Yeah, either of those approaches are fine. It just depends. Depends on how you are wired.
Yeah, that's right. That's right.
Dr. West and I are wired in very peculiar ways.
Yes.
In any case, whatever sticks in your head, whatever's going to
Yeah.
make salient, and you're going to be able to remember it. Either one of those approaches are going to give you the exact same result, and choose the one that you like best.
Yeah. Eric's exactly right. And you just never know. Some people just think of it one way. Some people think of it another way. And either one will get you points on an exam sometime in the near future. So anyway, that's all we have here for our ad drop. And with that, I think we're out, Eric.
Yep, yeah.
Have a great day, and we'll catch up with all you guys later.
See ya.
All right.